Good afternoon, Oak Bloke here, and I'm going to talk about this article that I wrote today, which covers the price drop over in silver and gold yesterday. So, reason to write this was I suppose, let's just quickly draw up the commodity prices into here. So the reason to write this was as we saw yesterday, a 27% drop in silver, 9% drop in gold, 4.5% drop in copper, 19% drop in platinum. I mean, lots of drops in various PGMs. And if we go down to PGMs and silver, gold, copper, palladium, similarly, nickel, similarly. So couple of reasons, and this video is just to talk through my article and my thinking and just the evidence that I'm seeing, and also my perspective on it. None of this is advice. This is just me giving my own personal opinion, but happy to answer any comments that people have on this, and just to kind of set out what I think's going on. So as I say, it was so it's this article that I've written, Bubble and Squeak. That's over on my Substack, which is theoakbloke.substack.com. And so it's interesting. That's the drop in paper silver. Similarly, you saw a moment ago, the drop in paper gold. Interesting if we go and look at the Shanghai Metals Index, where there is no paper, it's physical delivery. Did it drop by 27% in Shanghai? No, no, 1.65% drop in in that exchange. So silver is actually 120 an ounce if you look at that market, and a lot of silver is produced in China. One of my ideas for 2026 is Silver Corp. We'll talk about that in a little bit later. And regardless of where it's produced, a lot is produced in South America and in other parts of the world. But a lot of it then gets refined in China. The smelting, a lot of the smelters are based there. So there's reasons to think that the Shanghai exchange matters. And also, I would sort of, in this article, I speak about the idea of and the relatively recent use of the word bubble in every sentence that contains the word, or the word gold or the word silver. Bubble, gold, bubble, silver. It's been a very frequently used phrase during January. And I question whether that is a just curiosity or whether that is an agenda. And I'm no conspiracy theorist. I think most of the conspiracy theorists are complete. Well, yeah, I've got an opinion of how sensible they are or are not. But look, I guess what matters is, as investors, as we make our own investment decisions, that of course, there are going to be people that are saying, "Oh yes, we're facing a crash. It's all going to be dreadful, and gold is overpriced, and this and that and the other, and silver the same. Demand has been destroyed for silver at these prices." So 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 there's of course people that are going to be giving these opinions, but there was people giving these opinions 3 months ago, which is what I sort of then talk about here. That if you sort of look at the plethora of YouTube videos and people sort of giving their views on the drop yesterday. Yes, there are people saying, "Oh, yes, we've hit the top, and now it's all downwards from here." But you can go back 3 months, and there was people saying it back then as well. So I guess we've just got to look at the evidence and make our own mind up. I mean, yes, as well. I think it's fair to say that there's quite a number of people within the market that have publicly said, "Oh, yes, I've sold my silver." Rick Rule is a notable example of that. For those of you that are following the Oak Block 25 for 25 idea, Mineral and Financial (MAFL), Jacques, the CEO, also said we have sold down a lot of our precious metal, and we're now moving into copper is our next conviction. Jim Mellon, yes, I've sold 80% of my gold and precious metals and pivoted into oil and gas, pivoted into BP and different companies. I think it was where, so there are sort of quite a number of notable people that have been saying, "Oh yes, I'm moving away from silver and gold," and diversifying risk is what it's all about. So I think there's no, I'm not saying that as a criticism, or I'm not saying that as a you should follow those people necessarily. Obviously they're very sensible people that have very long track records of success. um, but I guess I'm guilty of tweaking a response on Jim Mellon, for example, saying, "Well, I'm happy to take the other side of your trade where you've sold down," because I believe his gold exposure was his holding in Condor Gold, which was sold to Metals Exploration, and Metals Exploration kind of unexpectedly really dropped to somewhere, I don't know, 12, 13p late last year. And of course, it's in January, I think, when Jim Mellon made the announcement, "Oh, I've massively sold down my precious metal exposure and I'm pivoting." So back when he was selling, I was buying. So I just said, look, I'm happy to take the other side of your trade, and I think metals exploration will do well from here. I get that you'd want to be in oil and gas, but certainly to sell off, and to move like in a huge pivot. I mean, yes, some exposure, yes, but yeah, I mean, and to be fair, I mean, if you look at oil and gas, um, for all the people that were saying, "Oh, well, we're in a surplus," I mean, that was another mantra that was being, like the word oil and the word surplus, oil surplus was just a mantra being repeated over and over, and yet here we are with Brent not just a touch below 70, and it went through 70 this week. It's in fact, I think it dropped yesterday below 70. Uh, uh, um, the North American price 65. I mean, well above the 60 where it was at. So so for all the surplus, why is oil back at 70? Why is it not dropping down into the 50s? Why is it not dropping down into the 40s? And hasn't at all. I think the low point, if I'm not mistaken, the low point for Brent was maybe sort of, it did very briefly drop below 60, but you can see it dropped briefly below 60 and bounced, retested, bounced. So to me, that's not a surplus market, not at all. So that's my perspective on that. So so the moving on the view of this bubble and gold, bubble and silver. I tried to trace back where has, like, who started this sort of mantra, and it appears to be that it's all based around this a report from the Bank for International Settlements, which of course is a very influential body. It's the central bank for central banks, who made the very valid point that, well, stocks are going up, gold is going up. When both are going up, you should sort of really have sort of one going up, one not going up. For them both to be going up introduces risk, because it sort of introduces what they term um, they call it stationarity, which is a word I'd not heard before, but it's this idea of that if both are going upwards, then there's no offset, or there's no there's no the correlation would would not sort of provide the counterweight to risk, which I kind of get. I mean, that's sort of sensible, I guess. That essentially they're talking about the potential of a bubble, but then there's evidence further on where I kind of would question that, and I'll sort of present the evidence as to why I believe that to be the case. So I mean, a couple of things first, though. First of all, I mean, mining supply of gold is well below the demand for gold, like by um, 1400 tons. So there was demand in 2025 was just over 5,000 tons. Supply was 3,650. Sorry, 3,670, and that was 20 tons more than the year before. So for all the people sort of saying, "Oh, there's a surplus of gold," well, I mean, in the sense that, of course, the demand, inverted commas, is people that are looking to buy gold at current prices, and of course that could change, and gold essentially gets stored; it doesn't get consumed in any particular, well, not in any great way, and even that gets consumed, for example, in electronics, if you look hard enough, if you own an iPhone or a smartphone, that contains some trace elements of gold. But producers are very good at recycling that because, of course, gold is very valuable. So they have, uh, um, you know, generally, gold will get recovered from industrial uses. Um, Whereas silver doesn't tend to so much. There is recycling of silver, but there's more of a sort of a sense of consumption of silver, and of course, it's not, because it's so much lower. 50 times cheaper than gold. That it's not as practical to recover silver in the same way as it is to recover gold. So, so this differential of supply and demand is essentially um, holders of gold are persuaded to sell gold in sufficient volume to make up the shortfall. But there is a shortfall in 2025, and there's no reason to think that. Well, there's no reason to think that mine supply is massively increasing in 2026. I mean, it will increase. Of course, the incentive is there for producers to produce more, but they're battling against depletion. They're battling against uh, um, the ability to invest, the ability to recycle cash flow. So it's not going to be instantaneous. I mean, I think that if the gold price remains at elevated levels, eventually there'll be a supply response. But 20 tons when the gold price was clearly increasing, the incentive was clearly there. The supply response in 2025 is very muted. I mean, it's not even 1%. It's like 0.6%. So really good fundamentals. Uh, I'd also make the simple point, and for those of you that bother to watch my videos, you'll know that I just try and come up with simple ways to explain the world. The Big Mac index as to why Japan is cheap, and the yen is incorrectly priced. Just simple things like I don't know. Yeah, just I try and from to my mind, it's not about finding economic variables; it's finding common day, everyday variables that explain. So the common day, everyday variable is that 2,000 years ago, a Roman could take an ounce of gold, buy a fine toga, and have a feast. Uh, Whatever they ate back then, probably lots of it, and Roman probably have wine and all sorts. But anyway, the same sort of money would buy you a wonderful bespoke suit, Savile Row or something, and a slap up meal somewhere nice in London's great restaurant scene. So that to me is again, there's not really a disconnect. You you're not going to go out and buy a top of the line suit, top of the line meal, and get a lot of change out of out of $5,000. You just I mean, go out and look for the price of it, and common sense tells you that gold is not vastly overpriced. It just isn't. So that would be a common sense thing to add. Just looking at the sources of demand, yes, jewelry is dropping, but I would make the point that um, jewelry is always relative to other assets. And I think the point that I would make is that yes, gold is down 18% in 2025, but I mean, platinum has been rising faster than gold, palladium, silver faster than gold. So will we see another drop in the demand for jewelry? I think jewelry is ultimately quite inelastic. Things like engagement rings, things like, yeah, I mean, at the end of the day, people sort of see it as the larger asset. It's an asset that you own. It's a hard asset that you own. So if the price has doubled, will the demand halve or less than halve? Is it elastic or inelastic? I would argue it's fairly inelastic in actual fact, because people will consider it to be of greater value, and they see it as an asset rather than as an expense. Well, not everyone. I mean, some people will consider it just simply an expense. It's going to cost me this much to propose to my dearly beloved, whereas a year ago it only cost me that much. But hey, that's I guess most people will not think that way. Not very romantic to think that way. Anyway, so I'd also make the point that if we just do things like, we'll say, relative to the US money supply, the reserve currency of the world. Well, if you and I've just chosen 1980 as a an arbitrary date in the line in the sand, but over the 45 years, money supply is up by far more than gold is up. So again, when you say gold, or when someone says gold is overpriced, well, no, I mean, it's not relative to the money supply. No, it's not. It's not even caught up, at par. Gold would have to be at about $12,000 for it to be relative to what the money supply was in 1980. It would have to be more than double today. So I don't sort of buy that argument. Uh, I'd also point out that, and I've talked about this before, but the progress that BRICS are making towards providing themselves and in fact the world, because they are all major trading economies. South Africa exports, Brazil exports, China exports. India, I mean, maybe not so much, but yes, I mean, it certainly imports and increasingly exports. I mean, they're all export economies. They really are. And so, what do you want to be able to do when you export? Well, in their minds, they want to avoid owning assets denominated in USD and trading in USD. So they've been moving towards this thing that they're calling the unit, which sounds like a Hollywood film, but it's not. And it's basically an alternative uh, um, uh, uh, currency or means of exchange between and among themselves, but increasingly then with trading partners, and also with major or with suppliers that are majorly reliant. So some of the Australian firms have agreed to be invoicing in yuan, for example, and not in US dollars. So again, there's definitely changes afoot that, and quite a bit of that was the sequestration of, or the attempt to acquire Russian assets that ultimately were they were the property of Russia, and the Western governments sought to acquire those, to pay for pay for the war in Ukraine, to give money to the Ukrainians, and the legality of that, and I suppose the idea of the rule of law. Well, the rule of law was bent to well, ultimately to do something that would be considered cheating. So these are the reasons that, and also just to I suppose the aim for particularly perhaps for China, but for other BRICS countries as well, is to provide a counterweight to the American hegemony, that they want to be able to be seen as a rival global power, or a block of power. So anyway, the unit is partially backed by gold, only 40% backed by gold, but that is in itself. I mean, if that means of exchange, if that means of trading continues to grow, it's being piloted at the moment. I mean, that alone, the amount of gold that would need to be held to support the level of trade and exchange is highly supportive of gold, and that is essentially an extension of the central bank buy-in, but they would need to hold far more to back the trades, and I would say that it's not just the BRICS nation central banks; it's other nations as well. There's plenty of evidence of other banks that are either repatriating their gold. Italy is the example I give in this article, but also just other countries that are building out their gold reserves. Poland being a good example, so yes, it's not just a BRICS only, but certainly it is a large part of BRICS. So 60% is backed by a basket of currencies, 40% is backed by gold. Will they move it towards more than 40%? Quite possibly, because that is a great way of uh, undermining the hegemony of the US dollar. And I know people are saying that the US dollar is going nowhere, and so on, and long may it continue. But um, I think I think trust is everything in the exchange of goods and services, and as that trust gets eroded, and you're competing against it's a bit like sort of the theory of Bitcoin. I mean, not that I'm any great fan of Bitcoin, but the theory of Bitcoin is that it's physically limited, so you can't erode or print money. You can't print gold. I mean, you could produce gold, but as I've just shown you, gold supply is increasing by 0.6%, growing by 0.6%, and is far below the level of demand. So it's relatively inelastic, and therefore a medium that is backed by real assets, not backed by paper promises. So that again, it doesn't feel like that has changed in any way, shape, or form. The unit would be an alternative to the Swift system. Again, it's a parallel rail. It's a way of providing an alternative. 6,000 tons is over 1 year's worth of demand for gold. I mean, demand for gold was 5,000 tons. The BRICS reserves would be 6,000 tons. Is over 6,000 tons, and that 50% of production is BRICS as well. And of course, some BRICS nations are not looking to topple the US or to do anything to undermine the US specifically, but it's to provide a de-risking, as they see it as a de-risking. So there's different motives potentially, um, and 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 I think the flaw that creates, again, it seems quite hard to think that um, gold will fall from its brief fall, a flash crash on Friday, that will fall back to something like 3,000 or 2,000 or 50, 1,600, I think was the previous low. So again, just seems very, very unlikely. So Another effect is the new Fed governor. That was another reason quoted for the drop. And again, yes, he's previously been hawkish, more recently been dovish. Dovish would mean positive for gold, hawkish would mean negative for gold. Again, there's reasons to think it could be either, but ultimately, when you look at Trump's rhetoric towards the former Fed chair, or the Jay Powell, I suppose technically the current Fed chair, again, it just does not feel like there's going to be any hawkishness. Because why would you appoint somebody that's going to oppose you? He will have appointed somebody who is, in my opinion, going to do what what he's told, I think. So again, it just doesn't feel like that way. When you look at the M2 money supply, it is still growing. I mean, there is no, like, if we were seeing a flattening out or a shrinking of that, yes, I mean, yes, you could sort of say yes, there's a reason for gold to be dropping, but that's not the case. That's not the case. The money supply continues to grow, period to period. It's also the case that when you consider the ratio of gold to the stock exchange, to the Dow, again, it's the case that uh, it's also the case that it's nowhere near the ratio where you would think that gold could retrace. Here at 1.3, so when gold Dow to gold was 1.3, it was extremely overvalued versus stocks. When it was at, for example, the dot-com high, stocks were 44 times gold. Today it's 10 times, so we're what, 8 times away, magnitude. So you'd have to be looking at something like $40,000 gold for it to be at the same ratio as it was in 1980, and we're nowhere near that. So the basis of really a relatively very small drop. I know percentage wise that looks a scary number, but 4887 relatively to this ratio has moved by a tiny fraction of 10 to maybe 10.1. So it's moved by a very small amount. Would if gold halved to, let's say, 2.5, I mean, it would be at something like the 1929 peak. And again, I just, with everything else and all the evidence, I just don't buy that. I really do not buy that. Uh, Equally with the S&P 500, same thing. That today it's at 1.4. 0.17 was the 1980 bottom, for stocks versus gold, and something like 5.5 was, you could take 5.5 ounces of gold to buy the S&P at the bubble. So today, I mean, we're several times below that. Is gold dropping because of reduced political risk? Well, there's an armada off the Gulf of the Persian Gulf. So I, I, I think that the whole sort of gold is pricing in political risk or geopolitical risk, I think, is very highly debatable, and plenty of examples where gold did not move on geopolitical risk recently. So why should an armada? I mean, if anything, an armada sailing towards Iran and hawkish comments of potential conflict, and yes, there's also other comments of like they're going to talk it through, etc., which may or may not be the case. uh, is any of that instructive to why gold would drop in price, or drop substantially in price from here? Again, it's a very tenuous link to be arguing that. I think commodities relative to the S&P 500, obviously it's similar really to gold, but gold is not, when you sort of look at gold versus commodities, I mean, they are similar ratios essentially. similar ratios. So is gold overpriced? Again, it just doesn't feel like you can argue that when you look at the numbers. So I guess to sort of summarize, to start to summarize, I guess the other thing I would say is supply increased by 20 tons in 2025. Is supply going to somehow vastly increase in 2026? A little bit, but not by enough to make a huge difference. As I say, perhaps in 3, 4, 5 years, yes, I could see it, but in this year, in 2026, I don't buy it. I think that it's naive to think that miners that have, I mean, yes, have had increasing levels of cash flow, are going to somehow going to be able to magically restart production. I mean, things take time. Investment takes time. Uh, taking and I know it's PGMs, not gold specifically, but Theresa, for example, I mean, they're not sort of vastly accelerating Caro, even though PGMs have massively increased in price relative. PGMs have more than doubled in price, but that doesn't necessarily mean that they can just turn a switch and they're going to start producing out of their second mine, Caro. They're facing depletion, as an example, where they're now having to go underground mining. So they're moving from open pit to underground in their first mine, in their Theresa mine. So this argument that high prices, high like high prices are solved by high prices. Well, yes, in the long run or in the medium term, but in the short run, no, I don't think that's a reason. Has demand been destroyed? Has supply been increased? I don't think so. I think there's lots of examples as well. I haven't put this in the article, but it was in one of my other articles. Or in fact, it was a comment that somebody made to me, and I have said, well, for example, silver is increasingly being used in solar panels, and if you look at the different generations of solar panels, and I haven't got the numbers directly in front of me, but the older generation of solar panels that use less silver were running at about 23, 24% efficiency. In other words, they'd be rated at 1 kilowatt and would generate 240 watts because they were 24% efficient. Yeah, so that's kind of, you don't get 100% efficiency. Um, the newer generation that are using more silver are running at about 25, 26% efficiency. So an extra sort of 2%. But over 20, I mean, what you've got to think about is, okay, yes, silver has increased in price. So the amount of silver per panel, per kilowatt has increased by, X dollars per panel. But what is the extra income of an extra 2% over a 25-year or 30-year panel life? When you actually do the maths, and I sort of did the maths and said, well, you're talking about a cost of 10, maybe dollars or tens of dollars versus an increase of income from that panel, assuming steady rates of electricity income, uh, of something like it's like a something like $1,000 return. Now, obviously, that's not all in year one, but that's the calculation people are going to be doing, is saying, well, these panels are costing me more, but they're producing a higher income, and that's the reality of, for example, solar. Is that they're more expensive, but yes, they're also more productive. So relatively, um, silver isn't going to necessarily face this demand crisis. And equally for jewelry. I mean, yes, silver jewelry is more expensive, but what's the alternative? I mean, yes, you could put, like, what's it called? Sort of, I don't know, stainless steel jewelry and stuff like that. But yeah, like, yes, I mean, you've got costume jewelry that can replace it, but at the end of the day, people want nice things, and when people's incomes are also increasing, and people consider it more of an asset, it goes back to what I was saying a bit earlier on, that will jewelry demand collapse because of higher prices, or is it inelastic? I think there's an argument to say that there's a degree of inelasticity because people then treat it more as an asset, and the asset is more highly valued. It's like, if we could all drink 1962 vintage champagne because it was, 5 quid a bottle. Well, we'd all be merrily drinking that, but its exclusivity makes it valuable, and its value means that people are prepared to pay X thousand pounds for such a bottle, because it's that specialness, isn't it? So would demand fall off a cliff with higher prices? Again, I don't think it's as clear cut as that in most cases. I mean, yes, you have substitutability and things like that, but silver has certain properties that are difficult to substitute. Its degree of reflectiveness, its degree of and so on. But I think the jury is out on that one. When you look at the 2025 demand, um, obviously in 2025 silver is much higher priced than 2024. Well, you don't see a demand going off the cliff there. Can't remember if yes, here it is. So within here, for example, we see demand has dropped by about 16 million ounces in between the forecast for 25 and 2024. And industrial, I mean, it's down by what, half a percent. You can see here the big drop here is silverware, down 15%. I mean, that is substitution, isn't it? People are saying, well, I'm not going to have silver spoons in my mouth. I'm going to have metal spoons. I'm going to have sort of, some other type of spoon. But look, I mean, that is what, 54 out of 1,100. So it's what, less than 5%. So less than 5% is dropping by 15%, but industrial is not dropping hardly at all. And then it's, what is it, photography? Well, photography's been dropping forever. I mean, you can go back, look. In fact, look, it's funny, but it's photography. Is that photography or is that jewelry? Nope, photography's up here. Yeah, photography. I was going to say photography's been dropping forever. It continues to drop because everyone has digital photos. We don't develop photos into actual photos anymore, and that's where the silver gets used. Jewelry, yes, I mean jewelry is dropping a bit, but pretty inelastic really when you consider that it's dropped by what, um, 12 million ounces, so by 6%, when the prices have doubled between 2023 and 2024, for example, in 2024 and 2025. It's well, in fact, between 2023 and 24, the demand has increased for jewelry. It's only here where it's dropped. So actually over 2 years, I mean, you're talking what, 3% difference of reduction of demand. So that shows that it's highly inelastic as far as I can see. I'd also make the point that just follow the money. Like, if you actually want to go out and buy silver, um, this was the Royal Mint's website. It's, physical silver is at a huge premium, and this is excluding the VAT element. By the way, I'm not including the 20% VAT in any of that difference. But you're talking about a 13% premium, and this was even for something that you can't even buy. I mean, like, this is how much it's for sale for, but you can't buy it. Oh, right. So, well, that's not really the price then. If I can't buy it, then it's pointless telling me that it's 94, £69 52, because you don't have it. Like, well, let's find somebody that does have it. Well, I found this one, and it's at a 25% premium. So you're paying, uh, on large volumes, $104, on one coin, $110, and yet paper silver is dropped to 84. Well, these haven't dropped 27% today. So is there a reason for that? Like, why would paper drop and physical not drop? Yeah, if physical had dropped, I'd understand it. I'd be like, fair enough. Okay, there's a problem here. This is something to worry about. But I mean, this is just my own thinking on it. Is that, like, for the physical not to follow the paper silver contracts, but also the physical in Shanghai. I mean, the price dropped 1.6%. Um, I'd also make the final point that silver to gold is a 15. I mean, physically, if you took, currently you can buy the ratio of silver to gold, I think is 57. Based upon Friday's prices. So if you took an ounce of gold and bought 57 ounces of silver and you kept doing that, because if you had an infinite pocket of 1 ounce 1 ounce gold coins and you kept buying those 57 ounces of silver, the world would run out of silver before you'd bought all the silver. Oh, sorry, before you'd run out of gold coins. In other words, the ratio isn't 57, it's 15. So for silver to have dropped as much as it has, again, I mean, just the physical nature of both of those substances in the world and the known resources of those, the ratio is not 57 to 1, it's 15 to 1. So again, another reason to feel that I mean, silver would have to increase by about over 200%. So silver would have to be at about $300 for relative to the current price of gold at 4889 for it to be in ratio to how much physically is available in the world. So anyway, to conclude, and I hopefully have just covered these points to sort of set out my thinking. I I don't know what the price of silver or what the change will be on Monday and next week or next month. I have no idea, no more than you do. And I'm not here to I'm not of the mind to be saying, oh, it might go up, it might go down. Because what's the point of me recording a video to tell you it might go up, it might go down? I mean, like, you can go out and find plenty of those as far as I'm concerned, pointless videos, just like wasting my time saying, oh, it might go up, it might go down. Right. Well, thanks for that. As far as I'm concerned, even if it does go down, I think the point for investors to just take stock of is like, at what point does it matter to if and assuming you're invested not in silver, not in gold physical, but in gold and silver miners, people, businesses that are producing. And I just sort of put this one up, and in my article I talk about Thor Exploration, which is a gold miner, but I was just looking at this today, which is Silver Corp. Now, Silver Corp are going to announce their third quarter results. In the next 2 weeks. But when you look at the price assumptions, uh, 39 39 $39 $39 silver is the assumption there, and that is sorry, let me just pull it back. That is on a price earnings of 15.8 times at that silver price. Now, part of that silver price is the fact that there is a discount to what they're doing because they are physically based in China. They're Chinese mines. And so some of that is that they don't get the full price. There's a something like, about from memory, I think a 15% discount based upon what the realizable price is through taxes and various elements. But um, silver would have to dramatically fall even after Friday's fall for it to matter to me. Yeah, there's a question: is the Shanghai price live? No, it's not live. I would say it closes over the weekend. But yeah, Sunday, something like Sunday about or Monday morning about 2 o'clock in the morning, the Shanghai price will be back up and uh, uh, sort of live again. So yeah, no, it's not a live price during. Well, at least I'm not aware that it's a live price during the weekends. I think most exchanges just shut, and it's closes Friday, reopens Monday. But obviously Monday morning is uh, 8 hours ahead. Shanghai, I think, is 8 hours ahead, if I'm not mistaken. So yeah. Anyway, to conclude, I suppose the other point as well that I also make is, and Silver Corp as the example. The other factor in all of this is that there's also polymetallic miners where, yes, they have a strong element of silver or a strong element of gold, but maybe not wholly so. That there's polymetallic, and for example, I would make the point that zinc is doing all right actually. So if we go and look at zinc, which is here, we would see that zinc is at 3,400. I think lead. I mean, lead's not at record levels, but it's at it's above 2,000. So that's sort of reasonable-ish. Um, that yeah, 3,400 is a decent level. You can see it's up 23% year on year, and 8.7% year to date. So copper as well. I think if we factor in copper to this as well, which is copper's up here, that that remains at an elevated level. Again, even after the drop. So to my mind, I think people that have panicked on Friday have and sold, just sold on the crash. I think probably have made a mistake. I decided. I mean, I had done some a little bit of top slicing and so on, and just had some spare dry powder. So I've actually deployed some of that into and it is averaging up, which never feels like the right thing to do, because it's quite nice to be, for example, Thor, I think I've got or had at 15 pence, and like you're looking at it and like it's up 600%, and there's a nice feeling to that, I'm sure you agree. But yeah, look, I mean, at the end of the day, I think it's even if there is a further drop next week, and even if I deploy more dry powder next week, I mean, I'm not going to go 100% into precious metals. I've got a diversified portfolio, and you make your own investment decisions. But I think diversification is absolutely key to what we should be doing. That you don't just bet the house on one specific thing or even one specific area. That you ultimately, my approach to investing is to look at a stream of cash over the lifetime of an investment, and that's what matters. It's not that it's gold, it's not that it's silver, it's just that it's going to generate a stream of returns, and that's what matters. So anyway, that concludes what I was going to talk about. Hopefully that sort of adds something to the article itself. If you like, if it's been a useful video to watch, please do like it. Please do share it. Please do subscribe. I really appreciate your support, and thank you for watching. And cheerio for now. Cheerio.